Well, the markets are certainly in a happier mood today. They've been licking their wounds from a brutal sell off on Monday all week long. And today, a sliver of hope, maybe? Slightly better than expected U.S. jobless claims data. And all of a sudden, everything's fine. The recession isn't happening, la di da. But wait, no, it was just one piece of data, and we're basically just oscillating in the same range where we've been since the worst of Monday's selling passed. And so now we come back and say, okay, well, as long as the markets continue to basically move sideways, and the next event risk that we really have to care about is probably next week, we can continue to unpick the rubble from Monday's shenanigans and try to figure out why things did what they did. So far this week, we've talked about how China will not be helpful for the global recession story as an offset. We've talked about yesterday how blaming Japan for all of this is probably misguided, almost certainly misguided. And today, we're going to focus on the euro because it's had a little bit of a strange run against the backdrop of all of these fireworks. And so we're going to take a look at it here and why it's been doing what it's doing, what that means for broader markets, and whether we can actually imply from its performance here that the euro is signaling that Europe in this overall negativity is somehow a refuge, somehow a place where returns can be sought, where safety can be had for capital, and if there is perhaps a rotation into those markets. This is, of course, Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And for this final episode of our market meltdown little sequence this week, we'll begin with just getting a sense of the price action. So here's a chart of euro futures. This is the continuous contract for the 6E future. And the thing to look at here, probably first and foremost, is the performance on Friday. That's this jump right here. And then the subsequent one on Monday amid the sell-off. A couple things to note here. First off, that surge on Friday, that was the biggest rise for the euro on a one-day basis in quite a long time. That was an increase of 1.1%. That's the biggest one-day rise so far this year. And then on the 5th, Monday this week, we can see it again surged. This was the highest level since January. Now, of course, we did ultimately retreat from those highs. That's after better than expected U.S. ISM data, the service sector coming in a little bit stronger, and that gave the dollar a bit of a lift midday on Monday. Had it recovering against the yen, had it recovering against the euro as well here. But nevertheless, I mean, this is a very strong showing from the euro at a time where you might expect that it would be suffering as risk aversion fuels liquidation and pushes capital into the likes of the US dollar, the Japanese yen. We, of course, saw it with the Japanese yen in spades when we looked at this yesterday. You can see it here with the timeline for when the sell-off started. As I've been droning on and on all week, Monday was not the start of this. Monday was an extension. It was a particularly crescendo-like extension. It was a very loud, very explosive extension, but an extension nevertheless, because if we look here at what's going on at the top panel here, in the green is the S&P 500. In the yellow is the Eurozone Stocks 50 index, which is essentially their benchmark stock index for the currency block. And you can see that both of them tipped over in early July. As a matter of fact, the index in Europe tipped over a little bit earlier. This happened July the 9th, the very day that Fed Chair Powell came out and said, listen, our risks have become balanced in testimony in Congress, saying we were just caring about inflation before. Now we're starting to care about growth and the threat facing the labor market almost as much as we are about inflation. And of course, that's what got the market saying, wait a minute. Not only are these rate cuts happening now, at the very next meeting, perhaps, or September to be sure, this sounds like the Fed is signaling a sense of urgency all of a sudden, but they're not going to be doing this for good reasons. This is not a maintenance cut. This is not one of those things where disinflation has resumed, inflation expectations have fallen. That, of course, drives up real interest rates. Real interest rates are the real cost of money that tends to be a very important source of the economy's health, one way or another. If the real cost of money is too high, that's of course damaging for growth. And if it's lower, then it's supportive. And you get there by saying, here's the nominal interest rate minus expected inflation, because obviously inflation can only be observed by CPI data or some other measure, but always in hindsight. And so it's the market expectation of inflation that really matters. That's the thing that actually moves consumer and business behavior. And so if you look at that and you say, okay, disinflation has resumed, inflation expectations fall, that's a smaller number you're now subtracting from nominal rates. So real interest rates shoot up. The real cost of money goes up. That's not what the Fed wants, obviously. They don't want to crush the economy. They just want the disinflation. So for much of this year, the expectation was as long as growth holds up, cuts are coming, but they're maintenance cuts. They're not a bid to stimulate because nothing is wrong. Well, the tone that the Fed gives us at the start of July very clearly says, actually, no, we're going to need to act to support growth, because the risks to inflation being too high, in our mind, are about as important now as the risks to the unemployment rate being too high and to growth being too low. You get confirmation of that as you roll through July. That very same week, you get weaker than expected CPI data. And the very next week, you get a speech from Jay Powell, again, this time in an interview with Carlyle Group's David Rubenstein. And he again repeats this same thing. So you get the Euro top, or the Euro stocks top here. You get the S&P top there. And going into this week's fireworks, the markets are in a sell-off. Notice what the euro is doing while this is occurring. It's going down. That's what you would expect. That's how you would think a normal risk aversion market behaves. Capital goes to the liquidity of the US dollar as markets get more defensive. Dollar goes up. That helps the euro. Not at all, clearly. It's not the world's most dramatic sell-off. We've had more pronounced losses in more overtly growth-geared currencies over this same period, like the Aussie or the Canadian dollar. But nevertheless, ultimate liquidity wins out. And then we get last Friday and the start of this week, and the tables turn. So we can see here, here's the wild shot lower for the Euro Stocks Index right alongside the S&P for that U.S. jobs data last Friday. And the euro, as we just said, takes a big leg up. That's this right here. And then on Monday, we do it again, right here. So there is a strange kind of change of course here in the euro's response to volatility and to risk aversion when the velocity of that risk aversion really accelerates. So we start to think, okay, well, does the market perceive some kind of a greener pastures argument in the Eurozone? it is certainly the case that growth in the Eurozone has improved in 2024 as relative to the preceding 5 quarters. We can see here the average over the course of 2023 and the final quarter of 2022 is a resounding 0%. So it's not quite the original bet on a recession. These numbers have since been revised. They were negative when they initially came out. They've since been revised to 0. So no growth, I suppose, is a little bit better than negative growth. But very clearly, the Eurozone was in the midst of a very anemic period in 2023 and the tail end of 2022. This year, it seems like there's a little bit more here. And if you want to use the kind of emphatic simile that financial media likes to use, you can see this is the highest growth rates that we've seen since the third quarter of 2022. So it's been a while since growth in the euro area was this peppy, never mind that it's still only 0.3%. But that's only at face value. And this is data that's arguably stale at this point. Instead, we look at the PMI data, which is much more timely, and we can see that, yes, indeed, as we go into the start of this year, there is a pickup. There's that pickup here. We can see it's largely a function of a more chipper set of circumstances in the service sector. So service PMI pushes through this 50 boom bust line as ever. In the logic of PMIs, 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so what you find here, this is a more timely guesstimate, as it were, of where GDP is going than the GDP numbers themselves, which we just saw are subject to revisions, are notoriously lagged relative to the periods they actually describe for when they're released. And so it behooves us to look at something a little bit more timely for what might be actually going on in markets now. And so we can see that here, that's that resilience in the first half of the year. We peak in May. We peak in the service sector a little bit earlier, actually, in April. But the overall reading, the composite index here in the yellow, that peaks in May because there was a slight attempt at signs of life in manufacturing that month. Note, manufacturing has been in contraction territory in the Eurozone to various degrees, going all the way back to the middle of 2022. So not tremendous signs of life, but something. And so you have here now a slump as services roll over and manufacturing remains anemic, where the composite index has basically gone back to next to nothing, next to neutral, right on top of that 50 line. So while there is clearly evidence that this sort of period got a bit of a reprieve, it seems to have been a very short one because we're back to where we started here. Moreover, if we look at the way that Eurozone economic data has been performing relative to forecasts, we find that it's increasingly disappointed. So here we are again, shock of shocks. This occurs going into the second half of the year after those okay numbers in the first and second quarter. Here you can see on the City Economic Surprise Index where 0 is the dividing line between where the data is tending to outperform by gradients of margin. So here we can see the data is increasingly outperforming. Here, the margin for outperformance is narrowing. At this point, we're below the 0 line. So the data is actually tending to undershoot forecasts. In fact, if we take a look at a nowcast for GDP from IFO, which is a German think tank, a very closely followed German think tank, we see that they still actually expect the second quarter number, which has already been estimated out, to perhaps get revised further, and we'll see those numbers. We'll see those revisions coming in here still, but they actually see it revised down to slightly negative. The really ominous bit is this: the forecast for the fourth quarter or the third quarter rather, of this year, and that looks quite negative at this point. Now, if you want to say that, okay, maybe this skews weak, and we already saw a 0.3% gain for the second quarter, so maybe it gets revised to something lower, but not quite as negative as this suggests. Okay, maybe this is a little overstated, and we end up somewhere here. So we get back to conditions that we saw late last year, rather than early last year. None of which is particularly good. I mean, of course, early last year was worse a little bit, but nevertheless, this seems to suggest that from here, things head lower on the growth side in the Eurozone, and the markets seem to agree. What we've seen over the course of July here is the outlook for the monetary policy path for the ECB has become more dovish. So much so that we can see right here is when the ECB issued that first cut in June. Before the cut, the expectation was that we would see rates come down by 67 basis points in 2024. So that's essentially amounting to at least 2 cuts at 50 basis points a pop, and then a fairly strong likelihood that we would get a third. So if we consider here that we essentially have 50 basis points already priced in, then you could say, okay, well, 67 out of 75 gives us a fairly strong likelihood that we would have that third cut. That's 17 basis points out of what's needed for that third cut, and that gives it a likelihood of 68%. Then, of course, we get the actual cut here, and we reset down because, of course, if one cut is already in, then the overall tally necessarily comes in. But look at what happens thereafter. We are now basically back to where we started. So we've had a cut, and we're back to where we were for the full year tally, basically within 3 basis points of the same cumulative total, which essentially just means, okay, now we're adding an extra cut. So as it stands currently, then, the likelihood of further easing has increased. There's been a dovish shift as this risk aversion in July has taken hold. And of course, that makes sense in the context of what's going on here. We have a global growth concern, and of course, then the euro comes down, which makes all of this that much more confounding. Why a global growth concern? Well, we come back to this familiar chart and we say, okay, we're in a situation where the Fed, as we just said, seems to have kicked off this sell-off by signaling they are now as worried about growth as they are about inflation, that the risk of over-tightening has really landed for them, and that they need to start to act now, that September is go time. That is not just a concern about U.S. growth. It is likewise a concern about global growth at large because of the three major engines of global demand generation, the US was the last one not misfiring until recently. We spoke in detail about the situation in China, where for 5 consecutive quarters you've had real GDP outpacing nominal GDP, such that the inflation adjustment to get from nominal to real seems like it's something on the order of negative 1.5 percentage points of GDP growth, which is eye-wateringly bad. And that's been the case now for about 5 quarters. So there's virtually no demand in China. And we already see that from data this week. We should get another anemic CPI and PPI data set later today to kind of underline the point. And of course, we've just gone through the Eurozone, the other major engine of growth here, where maybe we had some green shoots at the start of the year, but they now seem to be coming apart. If the US is slowing, then the global economy is operating without a safety net. And all of this 50% of GDP that's generated by these three economies is now misfiring, and the rest of the 50%, where all the other countries sit, is threatened because they tend to be vendors to these three. They tend to be export-led and servicing demand in these three nodes of output. So if we think Canada or Mexico and the US, Central Europe, Nordic Europe, even the UK and the Eurozone, Australia and New Zealand, commodity exporting parts of Latin America and Africa with China. So Southeast Asia and China. So you're looking at a situation here where you're not just talking about a US downturn, but a global one. And you're starting to see some of it. Here's the global set of PMI numbers, and we can see that for 2 months already, this is starting to go the wrong way. And the global surprise index, global economic data, that's been an almost direct straight line down since the US data flow side of this started to roll over around mid-April. What does all this mean for the euro? Well, maybe the way that you reconcile all of this is you say, this is what happens to the euro in quote unquote normal risk aversion, because we are talking about a recession that is being threatened at a global scale. And what this is liquidation. European stocks fell so hard, so much money went to cash, and the euro is, of course, the second or third most liquid currency after the dollar, depending on the day, usually the second most liquid. The yen is also in the sweepstakes there. But it seems like this was the one-off, and this is what's normal. And if, in fact, we are looking at the ongoing concern about growth here moving forward, at least into next week as we get CPI data, at least through the rest of August as we approach that September Fed meeting when those cuts are ostensibly coming, it looks like the euro here appears a bit rich. And of course, it's sitting very appetizingly at resistance. So if we were perhaps to get a close back under 109.23 and slip back into here somewhere toward the 109 figure, suggesting the consolidation has given way, there could be opportunity here to be a seller into the 108 figure. And if thereafter this series of higher highs and higher lows gives way, well, then we could get some real fireworks on the downside. And that is macro money for today. As ever, We are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what happens thereafter. I'm back on with Chris for Futures Power Hour tomorrow, as I am every Friday. I'm on with Victor Jones and Tom for First Call Sundays. Back with Victor for the Price of Truth on Wednesdays. If you haven't checked that out, yesterday's episode was especially spicy. I was on with the great and legendary Ira Harris. Check that out on the replay or on YouTube. I'm also writing for the news and insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for watching. Macro Money's back next week. Take care.